In this audio, you will listen to real-life explanations of 7 important economic and business terms. These terms are often used in news, business reports, and government decisions. As you listen, try to understand how each concept affects people, companies, and the economy in everyday life.
First phrase. Inflation targeting. Inflation targeting means that the central bank sets a clear goal for how much prices should rise each year, usually around 2 to 5%. For example, if bread, transport, and rent become more expensive too quickly, people become unhappy and businesses struggle to plan their costs. The central bank watches price changes carefully and uses financial tools to keep inflation under control. In simple words, inflation targeting is like using a thermostat to keep the economy at a comfortable temperature, not too hot, not too cold. Second phrase. Expansionary policy. Expansionary policy is used when the economy slows down. Imagine many people lose their jobs, companies sell less, and people stop spending money. In this situation, the government or the central bank tries to wake up the economy. They may lower interest rates or spend more money on roads, schools, and hospitals. The goal is to encourage people to borrow, invest, and spend again. Expansionary policy is like pressing the accelerator pedal when the economy is moving too slowly. Third phrase. Money supply. Money supply simply means how much money is circulating in the economy. This includes cash, bank deposits, and digital money. If there is too little money in circulation, businesses cannot grow easily. If there is too much money, prices can rise very fast. The central bank controls money supply to keep balance. Think of money supply like water in a river. Too little causes drought, too much causes flooding. Fourth phrase. Interest rate hike. An interest rate hike means the central bank increases interest rates. This affects everyone. Loans become more expensive, so people think twice before borrowing money to buy a house, a car, or start a business. Companies also become more careful with investments. Governments use interest rate hikes to slow down inflation and control fast price growth. In daily life, it feels like a warning sign that borrowing money is becoming risky. Fifth phrase. Reserve ratio. The reserve ratio is the percentage of money that banks must keep and not lend out. When you put money in a bank, the bank cannot lend all of it to other people. It must keep a part as a safety reserve. If the central bank increases the reserve ratio, banks give fewer loans. If it lowers the ratio, banks can give more loans. This tool helps control how fast money moves through the economy and how risky banking activity becomes.